In just 3 months, American Express handed Delta Airlines $2.4 billion. Yeah, let that sink in for a second. $2.4 billion in pure cash just for co-branded credit cards. Welcome to the Edgar Brief. Today, we're cracking open the Q2 2026 10Q from Delta Airlines, ticker symbol DAL, filed on July 10th, 2026, translating it into plain English. Quick note before we jump in, we are independent, not SEC affiliated, and absolutely not financial advisors. We use AI to help summarize these filings so errors can happen. Always verify on sec.gov before making any money decisions. Okay, let's dive right into this.
Here is our flight path today. We'll hit the welcome and business model, the scorecard, the moat check, reading between the lines, red flags, and finally, the bottom line.
So, Section 1, Welcome and Business Model, more than just planes.
Look, if you think Delta is just a company that flies metal tubes through the sky, you're kind of missing the bigger picture. Notice how premium products brought in $6.9 billion. That actually beats standard main cabin ticket sales at $6.8 billion. People are literally paying up for comfort. Then, add in a loyalty program bringing in roughly $3.9 billion, plus over $2 billion in third-party sales from their very own private oil refinery in Pennsylvania. Think of it like this. Delta is essentially a high-end country club attached to a transportation grid, making money by moving people and selling loyalty miles to banks.
All right, moving to Section 2, the scorecard. Q2 2026 Financial Reality Check. We always want to know the top-line answer. Are more dollars walking in the door compared to this time last year? The answer is a massive yes. Delta pulled in nearly $19.8 billion in operating revenue this quarter. That is a huge 19% jump from Q2 of 2025. This surge was driven heavily by that booming premium seat demand we just talked about, massive loyalty growth, and some serious pricing power. Basically, they're passing costs onto the consumer, and the consumer is paying out.
But well, here's where the rubber actually meets the runway. Operating income, the actual profit from running the business, was about $1.9 billion, and that is actually down 11% from last year. So revenues are up 19%, but profits fell 11%. What we're looking at here is a classic cyclical cash cow that is currently facing some severe margin pressure. I mean, bringing in more money doesn't really help if your costs are rising even faster, right?
Which brings us to an absolutely crucial metric. Let's quickly define free cash flow for a second. In plain English, it's the real cash left over after paying the bills, because accounting profit can be total fiction. You can't pay your employees with accounting adjustments. You pay them with cold, hard cash. So the real kicker here is that Delta's free cash flow for the quarter was $209 million. It's a pretty modest number compared to their giant revenue, but it stayed green, meaning it's positive. And honestly, that's pretty impressive when you realize they spent about $1.5 billion this quarter alone on capital expenditures, mostly buying shiny new planes and upgrading their tech.
Now, you might be wondering, how long until the lights go out if things suddenly go south? Well, Delta is sitting on a massive war chest of about $7.7 billion in liquidity. That's cash, short-term investments, and undrawn credit lines. Stack that against their total debt load of roughly $12.9 billion. Yeah, it's a heavy debt burden, which is pretty typical for an airline, but with that much liquidity, they have plenty of runway to weather temporary storms before things get scary.
This naturally leads us to a big question. If running an airline is this ridiculously expensive and capital-intensive, why can't a well-funded competitor just easily crush them tomorrow? Let's find out in Section 3, the moat check, brand power and network effects.
Delta's defenses really come down to two massive advantages, brand power and network effects. Think of it as a moving velvet rope. The SkyMiles program acts as a highly exclusive club membership. Once a customer has a Delta Amex card, lounge access, and a huge hoard of miles, they are economically and psychologically locked in. A competitor can't just buy that kind of loyalty overnight. It is the engine generating those billions in American Express cash we talked about right at the start.
Moving on to Section 4, reading between the lines, the narrative versus the math. When you look at management's narrative in the discussion section, they are understandably popping champagne. The story they're telling is all about record top-line revenue, 19% growth, and booming premium demand. But the math tells a slightly more sobering story. Total operating expenses jumped by $3.3 billion. That's a 23% increase from the exact same quarter last year. When your costs jump 23% and your revenue only jumps 19%, your profit gets completely squeezed. Management owns the results for sure, but there are massive headwinds burying themselves deep in the expense columns. Which brings us to Section 5. Red flags, tangible risks in the filing. Skipping all the generic industry filler, there are 3 glaring, concrete risks jumping right off the page in this quarter's filing. First, a massive spike in jet fuel costs. Second, structural, permanent increases in payroll. And third, a sizable chunk of debt that needs to be dealt with very soon. Let's zero in on that fuel cost for a second. Delta reported an 80% spike in their average jet fuel purchase price, hitting $3.66 per gallon. Even with their Monroe refinery acting as a sort of personal gas station to hedge costs, broader market and geopolitical disruptions added roughly $1.7 billion to their fuel bill this quarter alone compared to last year. And unlike a flexible marketing budget, you literally can't fly a plane without fuel, and you can't easily negotiate with global commodities. Add in the 4% base pay bump they gave employees in June, and you can see exactly why that profit margin is shrinking. Plus, they've got about $2.8 billion in current debt maturing within the next year that will require actual cash to settle. So what does this all mean? Section 6, the bottom line, the verdict. Here is the final verdict. Delta is a massive loyalty club and premium transporter with incredibly strong demand, but they are highly vulnerable to macro cost shocks. So what should you look for in the next 10Q? 3 specific things. Number 1, watch jet fuel prices. Management noted these elevated costs are going to persist. If fuel goes up again, margins will shrink even further. 2, monitor premium seating revenue. Right now, wealthy travelers are basically subsidizing the higher costs. If a recession hits and premium demand softens, Delta loses its main profit engine. And 3, track the SkyMiles AMEX remuneration. That $2.4 billion cash injection is the golden goose. As long as it keeps growing, Delta has immense financial flexibility.
And that's your Edgar brief on Delta Airlines. Remember, this was a translation, not a recommendation. Read the original filing on sec.gov if anything we discussed piqued your interest. Thanks for being with us at the Edgar brief. See you in the next filing.